Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alix Steele. Let's talk about one area of the market that could see a real uptick if the Fed continues to cut. And will be very exposed if they actually don't cut as much as we expect next year, and that's going to be real estate. And we talk about commercial real estate, but then there's actually luxury real estate, which you might not associate with being super sensitive to like a 7% 30-year fix, but actually it is.
Yeah, I would think so. But it was interesting, too. I mean, Bloomberg was reporting today that at least here in New York City, the luxury real estate market has seen quite a bit of a rebound just over the last couple of months. They're talking about 90 contracts signed last month for homes that were worth they had selling prices of $5 million or more. I know you were probably one of those people. Right?
No, you're the one looking.
I know, I was looking.
I have a 2.75% 30-year fix.
Look at you.
Girl dying
Don't
in this
brag.
apartment, okay? But anyway, we want to get more on this and sort of what is the forecast then for 2025, particularly if we see a little bit less hiking cycle from the Fed. Francis Katzen is founder of the Katzen team over at Douglas Elliman Realty. How's it been for you the last few months?
Bonkers. It's been really busy.
Which months were busy? Where in the space? Tell us more.
I think it was a mixture of an election being solidified, compounded by rates that were reduced by 50 basis points in October. And in fact, in November, we saw 246 contracts signed for that month, which was the third highest in the past decade. And just last week, we saw 37 contracts signed over $4 million, which is the entry luxury. That was 15 more than the week prior, and 13 of those were over $10 million.
Wow.
Yeah.
So what is your take on that? I know you said the election, but when you say $4 million, I'm like, are they really getting their 30-year fix? Like, is it that much sensitivity to what the Fed is doing? I
would have to say one of the most staggering insights as a broker on the streets that I observed this entire year was when the rates were hovering at 7 and 8, we literally saw between 4 million and 4.999 a 53% reduction in trade. That was really staggering because you think luxury entry 4, who really needs the leverage, they did. It was very interesting.
Where are they buying? Is it in sort of the typical pockets that we normally think, or have they fanned out to sort of places that we don't know about?
Well, I think...
He's asking for a friend, by the way.
Well, it's actually interesting that 240 whatever, you had 129 in Manhattan and 96 in Brooklyn.
Yeah.
Which was interesting. That's a very different number. I think it was only 53 the year prior, year to date.
And for our viewers who maybe aren't familiar with the New York real estate market, in the old days, Brooklyn would be kind of the bargain.
Section.
Yeah, that was the bargain, and now you're seeing a lot more high net worth individuals, celebrities, of course, move into neighborhoods, Brooklyn Heights, where she lives, or we're out in Brooklyn. But in all seriousness, it gets to this idea, though, too, of this activity. Was this just kind of a catch-up, meaning all the activity that would have happened early in the year now is just flooding into your inbox at the end of the year, and then that's it? Or is this kind of an uptick of momentum that we're going to see into 2025?
Boy, I wish I had a crystal ball. I would imagine it's going to continue. I think if there is this prediction of additional rate drops, maybe 4 times throughout the year, I think it is meaningful. And I also think the capitulation in the sales market from the stagnation has made it such an opportunistic diversification.
Maybe you can't answer this question, but this gets to the whole idea of interest rates as well. What about sentiment? I mean, how much are your clients affected by just broader sentiment about financial markets and the economy? We've been talking a lot about how sentiment has shifted given the outcome of the election. There's a certain, obviously, class of people in this city that think good times are ahead, economically speaking. And I wonder how much of that maybe could have fed into the increase in real estate activity.
I think that's a really great question. I would also say that the earnings reports from Goldman and Citi didn't hurt. They actually performed. They outperformed. And I think that had a bit of a trickle impact into the malaise lifting. I also think, I think diversification is part of how you make money. And I think real estate does that.
Well, and to that point, we should point out, we've been reporting bonuses are supposed to be incredibly high this year. So I think come February, you might see a lot more activity.
Well, actually, but that's not a terrible point. And you also had then the crypto, the rally there. Some random meme stocks are also doing well in random moments, and then the equity market continues to be on a tear, even if we have days like this where we don't go anywhere fast. What do you expect, though, if we get just 3 basis point cuts? 3 cuts from the Fed next year rather than 4. Like, does the number matter, or is it the trajectory that really matters?
It's the trajectory. I think people psychologically can bite down on a higher rate if they know that it's going to reduce a little bit. I think also the discussion of SALT deduction helps.
Oh, yeah.
That's a big one for
Even
entry.
if it's just 20 grand?
I was just going to say, it doesn't seem like a lot, but you know what? That's 40 grand pre-tax. So it's meaningful. It all adds up. Inflation is not fun. Everything is expensive.
Inflation, that's actually the best. Inflation is not fun, period. There we go.
It's not fun.
Okay, so then give me a sense of what kind of things are selling. I know luxury, but are we talking brownstones? Are we talking new buildings with super high amenities like a pool? Is it old buildings that are retrofitted?
The new development market has performed extremely well. I think the buyer pool has had more demand in what they want for their lifestyle. It's normally a home office, more sort of, green design, more mental health sort of experience, spa level amenity type of product. The new development has been very strong because they've been able to offer newer product with more amenities. But in terms of the resale, I think it's still holding. I think it comes down to absolute price.
Francis, I do have to ask you a little bit about the lawsuit and settlement with the National Association of Realtors and how that affects the commission structure for real estate agents going forward. I mean, what's been the adjustment so far since that settlement? And I mean, I don't know if it affects necessarily the type of clients and people that you work with, but overall, for just the real estate market overall, is there going to be a big impact on who stays in this business and who maybe gets out?
It hasn't. I think that there's been somewhat of a revolution to it. It's such a de-incentivizing friction cost that has no upside for either the building value or for fetching a higher price. There's no real smart way to make it make sense. So I think basically the owners are ignoring it and are saying, I'm still going to maintain it. And the buyers are like, thank you very much, because the last thing I want to do is throw that on my back, compounded with a higher interest rate and a mansion tax and any transfer taxes if I'm buying a new construction. It's the most counterintuitive thing you could do to drive an economy, in my opinion.
All right, Francis, we'll leave it there. Always great insights out of you. Francis Katzen there is the founder of the Katzen team over at Douglas Elliman Realty, responsible for, last time I checked, I think at least $2 billion in transactions over the years. And